We've reported before on this programme that there's been a rise in people who are taking out mortgages over more than 25 years. The Building Society Association told us some people are even taking out loans with terms of 40 years. It's common amongst younger people to lower initial monthly repayments, but now it seems parents are doing it to help their children get on the property ladder. Keith Travis in Kent has just taken out a 40-year home loan which will stretch out until he's more than 100 years old. The mortgage was to buy a flat in the name of his son James.
We own a property outright. Because it was £100,000 additional mortgage on a property worth £700,000, it's a very, very low risk from the point of view of the lender, and so attracts a reasonable sort of rate of interest, and it's coming in at about £340 a month. So it's a lot cheaper than renting.
And what were your feelings? Just tell me about your motivation, basically, of doing this.
I'm reaching a stage where I thought if I leave it much longer, I'm not going to be able to find it easy to raise capital because of my age. So we wanted to move on something now.
James, to bring you in, why were you not able to buy yourself? Explain your situation.
I am a self-employed video producer, and like any self-employed person, you need a lot of books, a lot of years of books to prove that you can repay the loans. So it just happened that I didn't have good enough books. Despite being able to afford the repayments, I wouldn't have been able to get a significant loan to buy anything more than like a garage in Hastings or something like that.
And how many attempts had you sort of made to try and get a mortgage?
Well, we went to a mortgage advisor and it was just, what do you call it, like a lead balloon. It was like a waste of time. You just sort of...
Wasn't even a garage, it would have been a kennel.
Yeah, you just sort of... I'd have to buy a dog just to justify the kennel, I guess. But it just wasn't like worth pursuing.
Keith, there are other ways you could have helped James. For example, you could have paid the deposit, for example.
Yes.
Why didn't you do that?
He more or less had the deposit himself together. That still would have been enough to get him a mortgage because of the lack of 3 years good, solid books.
Now, according to the Building Societies Association, some lenders will have a maximum age limit on a mortgage, or, could be 70, could be 80 years old. How easy was it for you to find someone to take you on?
You do have to hunt around. It's not going to be the mainstream high street lenders. It's going to be the smaller building societies who were willing to look at this sort of thing. We still had to show that in the event of James being unable to pay the mortgage, we would be able to cover it. In the worst possible situation, we would just have to sell the property.
So, Keith, what's the long-term plan here? Because presumably you don't expect to still have this debt in your 90s.
No, of course not, no. It is very much going to be a stepping stone. At some point, James will take over the mortgage in his own name. So it's very much 2 years and then review what's happening.
Keith and James Travis. Well, Henry Pryor is an independent property expert. I asked him if this is becoming more common.
Well, I think that perhaps it's an unusual way for it to be done. We know in the housing industry that the Bank of Mum and Dad, as was announced just earlier this week, is now by volume the 10th largest lender in the mortgage market if you heap all the help that Mum and Dad up and down the land are giving their kids. And not surprisingly, we know that getting onto those lowest rungs of the housing ladder is incredibly difficult. So this is not unusual, but it does come with some severe caveats.
We'll come to the caveats. We've heard from them it was quite hard to get this loan. Is that surprising? Are many mortgage companies doing it?
Well, it's not surprising, and frankly, if those of us who are old enough and wizened to have worked through the credit crunch of just over a decade ago, thank goodness lenders are being a little more cautious about to whom they lend and on what terms, because we all know that housing played more than its fair share in the downfall and the creation of the credit crunch. So it's good to find that lenders are being not difficult, but certainly cautious when it comes to the loans that they advance. Clearly, this was an unusual way of advancing the monies, and there has to be, obviously, speaking bluntly, the chance that the loan will survive the parents who, in this case, are effectively underwriting it. Because what we're looking at here is a mortgage that's going to go on past their lifetime and have to be dealt with and picked up in the estate when they sadly depart.
And the positives are that James, the son, gets out of the rental cycle, but you've talked about downsides and risks. What are they?
At some point, the housing market will rebalance. We know that house prices don't always just go up, they also come down. And as a result, there may be people who, hopefully not in this particular instance, but cautiously we have to be aware that there may be people who, if house prices do turn down, are left either with no equity or worse still in negative equity.
There are rules about inheritance tax and gifts and so forth. Is there any danger this would infringe those?
Certainly anybody who's looking at following this example should speak to a qualified accountant to make sure that they're not going to find that they leave an unpleasant legacy, that it is one that is beneficial, as we certainly hope will be the case here.
Now, the Building Society Association says affordability criteria and responsible lending apply to these as for any other mortgage applications, as you've indicated. Lenders involved are versed in the different risks that apply to lending to older borrowers. And then they also say pension income is often fixed, which is a positive, but clearly health and mental capacity become a much bigger consideration. So one presumes they won't be lending without properly evaluating the customers.
Well, we very much hope that that is the case, but in this case and in subsequent examples that may follow, there's got to be a question mark about exactly who the customer is and who is ultimately responsible for the loan. One of the crazy situations we find ourselves in today, that we have got to us a place where mum and dad are having to lend money to their kids so their kids can afford the prices that mum and dad's mates are charging for their homes. If we continue down this path, we're going to inevitably see more of these sort of examples with the added anxiety that will go with it. And there are lots of ways of addressing it. This is just one of them, but I have to say it's not my preferred option.
What would your preferred option be?
So perhaps the more traditional way of helping out your kids with either help with the actual deposit or providing guarantees rather than actually taking the mortgage out specifically in this way would perhaps be the way that we would expect to see it done more rationally.
Henry Pryor speaking to me earlier.